delay. Okay, so I think just looking forward, if I have the dates right, I think we have our check-in assignment on Tuesday, which is kind of like going to be another lab session in class or online, where the hope is that all the groups will have a small, like a minimal working example, not your whole model, but like a component of your model, kind of like one sector of your model or a micro sector of your model that you could hit play on and generate a graph that would make sense for that sector. And if you changed a variable to move in the right way. So by make sense, I mean like there won't be like obvious errors where you've got a population variable that goes negative and population should never be negative, you know, those sorts of things. It's kind of functioning as designed. We kind of verify there are no bugs in it. And that'll give confidence that you've got enough momentum to kind of keep moving forward, building the rest of the model. Now, if you can't show me and Eric that minimal working model by the end of the class, that's fine. You can just record, you know, a 2-minute demo on Zoom or whatever, and then you'll be able to upload it. I think I've got the deadline set for Sunday. So if you don't get your credit in class, then you can get it by uploading. So if there are questions about, of course, you know, you can try to meet between now and then for office hours, but if there are, you know, we can also view it kind of as a lab thing. So if you're having problems, I can help you debug those problems. And if you can't fix the problems by the end of the class, at least if you know what the problems are, you might be able to fix them and then upload that quick little demo by the Sunday there after. And then I'll review those demos online and you'll be all set. So that's kind of what's looking forward for the final project. Any questions about that? Pretty clear what the timeline is. All right, questions online. Looks like we're good. Okay, so otherwise, besides final project stuff, the last couple of lectures here, we're going to go over a couple of examples from the book where sophisticated system dynamics models were used to analyze real-world problems. The one like from this chapter is a little more sophisticated than I'd expect for your final project. So if you went this far and you were successful, great, that's above and beyond. But it's probably, you know, it'd be a good aspirational goal, but it's probably got a few more stocks than most of you will have in yours, but at least shows you some of the things that you can do. And so those would be kind of the examples there. And then we'll close in Unit G with some more advanced topics like chaos, so we can see how that kind of is into there. And then Eric will give a kind of a guest lecture on how these quantitative methods have helped him in his work, doing his graduate research in sort of thinking about water in irrigation systems and things like that around Arizona. So that's kind of the plan moving forward. So we focus on this chapter, chapter 8. So it's all about oil, which certainly is topical. And so ideally, if you think about modeling oil, you've got to model the whole world to really get all the dynamics in there. And that whole world is thousands of firms producing oil, billions of consumers. So ideally, it seems like this would be too big of a model really to be able to build something realistically. And so you have to ask, you know, do we really need to model all of these things to be successful? And the idea here is that maybe if we adopt a certain perspective, we can coarse grain aspects of the model out. So we don't really need to know about every firm or every consumer. We can model sort of their impact on the population as a whole. And so that's kind of what was done in this chapter. So instead of modeling the individual firms, we model groups of firms together. So we have kind of the independent firms, you know, the kind of the oil producing firms outside of OPEC. And then if we're focusing on OPEC, the Organization of Petroleum Exporting Countries, if we focus on OPEC, then that's where we kind of go in, you dig down deep and kind of look at the details of sort of how does OPEC affect the industry as a whole. So we don't really need to know about the individual firms outside of OPEC because they all kind of like don't have enough control over the market to make a difference. We really kind of care about them kind of bundled together. So we just model them as one sort of entity kind of together. That's kind of the idea here. But why do we, you know, what's the use of building these models? So this comes from a real example. So back then, Royal Dutch Shell, now Shell. So this is a true modeling story where Morecroft was a consultant working with Shell doing scenario planning. And so this is back in the early 90s. And so Shell knows that their business is naturally global. And so they were interested in knowing what are the possible things that could happen in the future scenarios that they might need to prepare for as they're making investment decisions and so on. And so they want to become more agile, recognizing trends, emerging threats, and so on. So that was kind of the goal here. The goal was not for predicting the future. So sometimes you think about statistical models where you say, given what happens in the past, what tends to happen immediately after in the future, that's maybe useful for trying to make, short timescale investment decisions. So, if I want to make money in the next month, where should I put my investments? This is about planning for a longer term to sort of understand, bigger perspectives for that sort of what if thinking. And so the idea here is to think about alternative futures in parallel, ways in which the industry could grow, ways in which the industry could collapse. What's kind of the things that definitely couldn't happen? What are the scale of things that could happen? And that will help guide decisions and how to move forward. So it's not about predicting the future. It's about thinking about the possibilities. So this is motivated by looking at data from the past, like this one here. So this is, as oil became a major commodity, as it displaced other commodities before it, then there's a lot of sort of puzzling dynamics that we'll kind of break down here. And the goal is to sort of say, are there models which represent kind of latent variables that are inside this that sort of we need to assert that they exist in order for us to make sense of these patterns? And so, because if we just look at these patterns, it doesn't make sense on the face of it. Like in the beginning of the industry, we've got wild fluctuations in oil prices. And then somehow in the late 1800s or so, this dude named John Rockefeller gets involved with Standard Oil. And once Rockefeller gets involved, then oil prices pretty much stabilize. They're far different from the swings here. And then after kind of Rockefeller's legacy, or after he's kind of done, then this new group of players gets into it. And they seem to be able to do even better than Rockefeller at keeping things stable. But then suddenly, there's this event that happens where OPEC seizes control of the Arabian Peninsula, and suddenly you get these massive oscillations here. And so you get this, huge rise in prices and fall. And so local, after that fall, people said, oh, well, that was just an anomaly. Then we expect oil prices to stay low again. But then, of course, a little bit later, oil prices rose again. So massive fluctuations that seem kind of random when you look at them just from a time series perspective. So the idea is if we can build a model where we know what all the kind of gears are, and all the cogs that are moving in that machine, and in our model, we can generate the same types of trajectories. It gives us a whole new perspective on what causes these sudden, massive spikes here. And that might actually help us predict when one of these spikes is going to happen. It might help us give an idea of how fast these spikes can rise, how frequent they can occur, and so on and so forth. Or it might help us prevent them from happening by taking certain policies, maybe they're geopolitical, maybe they're natural resources related, and so on, so that we might be able to buffer these things out. So, for example, you might have heard the president is tapping into our strategic reserves to help manage oil prices. And so, how much reserves do you want to keep? That sort of thing. These sorts of things can give you an idea as a policymaker on, how much of a buffer you need, and so on and so forth. So, so that's the idea. We're trying to build system dynamics models to help explain these patterns in the behavior over time. So how do we do that? And so this is something that might show up in some of your models. It's just price determination, basic microeconomics. How is price determined in a market? So before getting into all the details of OPEC, we can just sort of think generically, how is price determined in a market? Well, we all probably, even if you've taken, how many people have taken a microeconomics course? Okay, quite a few. So, you're probably familiar with supply and demand and the X that those form and so on and so forth. And so it's this balance, this gap between supply and demand, which drives, Well, it drives quantity demanded and quantity supplied, but also will ultimately also drive changes in price. And so we can model that. We can model that dynamic process. And so we have to think about like, well, whenever we hear about gaps and sort of chasing gaps, kind of like chasing your own tail, whenever the gap is high, the price will go one way. When it's low, it'll go the other way. It should remind us of a particular system archetype. So what archetype did, you've built this archetype multiple times, and it involves a gap and responding to a gap. What's the basic archetype that goes along with regulating gaps to zero? Any thoughts? Think about what, you've probably written this word gap on several homework assignments. And it's a real simple, it's a single loop. Anybody?
Is it a balancing loop?
I hear online question, is it a balancing loop? How many people would say that a balancing loop might be involved in regulating gaps? Does that sound familiar? I see some hands in the back. That's good. Yes, that's what I'm looking for there. A negative feedback loop with delay, a balancing loop. So whenever you think about like, how do I build these models? We're like, well, the microeconomics people say that if supply is bigger than demand, we tend to see prices do this thing. If demand is bigger than supply, we tend to see prices do that thing. We realize, well, the gap, the sign of the gap, whether it's positive or negative, seems to be moving the price in such a way that ultimately the gap is being reduced. That's negative feedback. That's a balancing loop. We should be able to build a balancing loop that has the exact same properties here. And so this is the way we do it for oil. So the basic idea here is there's some supply, there's some demand. So this is how many barrels of oil everybody wants. This is how many barrels of oil are available. And there's a gap here. If that gap is positive, then it's going to cause the oil price to go up. That oil price that's going to go up is going to encourage independent producers to invest in providing more supply because they want to make more money. After some delay in that investment, they'll then provide more supply, which will close that gap. On the other hand, if that gap is negative, meaning that more is being provided than is needed, then the oil price will go down because they just want to get it off their hands and because they need to sell more oil than people want. And ultimately will stop investing and maybe they'll stop drilling. So after some time, that'll reduce the supply of oil. So ultimately, the price dynamics can be governed by a simple balancing feedback loop with delay, similar to the tank gap that you did in assignment E2, where you added a delay, and that created these kind of oscillations that you saw in the toilet, where it would go well above, and then somehow if the valve could pull water back out, it would come back down, and so on and so forth. So we can say, well, we know that these balancing feedback loops with delay produce oscillations, kind of similar to that tank gap model where it produced that oscillations. Could this be an explanation for some of the characteristics that we see, Gesundheit, in the time series, the oil time series we already have? And it seems plausible. If we go back and look at this time series, then we know that investment maybe takes about, say, 5 years. So by the time you start investing, you actually start seeing oil supply increase. At least with these technologies, maybe it takes about 5 years to do that. And maybe some of these oscillations here kind of goes up, comes down, goes up, look like oscillations that might be generated by a simple balancing feedback loop with delay. So maybe we've explained what's going on here. But the problem is, this is super stable, no oscillations there. So what's going on there? And what's going on over here where these oscillations changed totally? So it seems like we've got part of the model, but we don't quite have it all there. So we need to add something to this model to really account for all of the things that we see in historical sense. So in this real world case, they got back together and they said, we can't just model this with a simple balancing feedback loop delay. This isn't a toilet tank. So now we have to think about what sectors are likely driving this. And they came up with these 5 sectors. They said that we've got all the independents, and they're such small characters that we don't need to break them out. We've got the price that we've got basically our balancing feedback with delay down here. This is what's setting the price of the market. But then over here, we've got OPEC. And OPEC is so giant that they have the ability to move the price all on their own. And the introduction of OPEC basically means that there's going to be some periods of time where it's basic microeconomics down here, supply and demand, oscillations, et cetera. But whenever OPEC wants, when certain thresholds are hit, they'll kick in and they'll totally change the price in a way that maybe doesn't make sense in terms of basic supply and demand. So that's basically what we're modeling here. So we've got the independent producers and the market signals, basic microeconomics on one side, balancing feedback loop with delay. And then we've got OPEC, the Organization of Petroleum Exporting Countries, on the other side. And they have explicit control of the market based on political and social pressures, not necessarily commercial logic. So this is a way for them to exercise power over the world as opposed to just make money. They make money too. All right, so the basic idea here is that OPEC is going to look at how much oil is going to be produced by the independent producers, and then they're going to set quotas and a desired price. So those of you who are familiar with the Federal Reserve, it's kind of a similar idea there. When they want to set interest rates, they look at what interest rate, the prevailing interest rate that's out there. They would like to lower interest rates to a particular amount or raise interest rates to a particular amount. And they have access to the ability to buy lots of stuff and sell lots of stuff. And that's how they control interest rates. It's the same thing with OPEC, where they are going to have so much access to oil that they can stop producing and cause prices to rise or produce a whole lot and cause prices to drop. So they look at how much oil is being produced by all the independent producers, and then they choose a desired price and then choose how much oil they're going to produce in order to bring things to that desired price. So they can control their own oil revenues by setting their own prices. I mean, they're a cartel. That's what allows them to do this. And the big important part of this cartel is the so-called swing producer. Does anybody remember who the swing producer was? Yeah. Saudi Arabia, right. So Saudi Arabia is in the Arabian Peninsula. Like, there's a lot of big oil producers there, but they've got a whole heck of a lot of oil. And so they basically have so much oil and they can get access to it so easily that they by themselves can kind of set world prices. Now, the other producers have enough oil that they can kind of create tension. That's the reason why this cartel exists. But ultimately, Saudi Arabia can cause more hurt to the other individuals if they're not in line. But if they're willing to take that hurt, then they can kind of also drive things. And that's what makes this cartel kind of come together. They also have similar kind of socio-political interests as some of the others in their cartel, which is another reason why they kind of come together. But ultimately, they are the so-called swing producer. And we refer to a swing producer in a cartel as the one who has so much capacity that they can drive the whole market. They can swing the market however they want. They just have that much mass. The market really hangs on them. So they provide a fast-acting feedback to ensure that the oil price is buffered against any commercial market pressures. So this is what takes the microeconomics out of it, because they can kind of set their own price, because they can dump oil and pull oil back out. And then they've got their other members of OPEC, the Opportunists, and OPEC in general agrees that these ones will produce some of the oil, but for economic pressures, they might decide that they want to produce a little bit more to make more money. And so they might, this is why they're called opportunists, they might violate the quotas and produce a little bit more. But if Saudi Arabia, the swing producer, notices that they're overproducing in order to get a little bit extra profits for their own country, Saudi Arabia can flip into a mode where they then way overproduce oil, drive the price way down, so that everyone in the opportunist group suffers with low oil prices. So you don't want to produce so much oil that the swing producer notices and then punishes the whole group by overproducing. So that's why we call them opportunists. They're always tempted to produce a little bit more, but if they produce too much, somebody's going to notice and they're going to get slapped. So they produce the agreed quota, and there's temptation for them to cheat and overproduce to get more profits. All right, so we put everything together and we claim that these 5 sectors are kind of enough we think. They're sort of the latent variables we need to explain all these things. This is a dynamic hypothesis. There could be other ways we could have sliced up the market, but here, really the investigation, the dynamic hypothesis here was that these swings are largely driven by stuff that's going on with this cartel. And we're testing that hypothesis by generating trajectories out of here and seeing if those trajectories match the trajectories we've seen in historical data. All right, so that's the basic idea here. So before we get into the basic stocks and flows that are underneath all these sectors, are there any basic questions about this architecture? Does it kind of make sense, the goals here? All right, well, let's do a mid-class attendance question. I haven't done one of those for a while. And the question I'll ask is, who is the swing producer in OPEC? So that's the question. Who is the swing producer in OPEC? Yeah. Oil. Yeah. Yeah, so that's a great question. The question is, why don't the opportunists get together and maybe work against Saudi Arabia? Is that kind of what you're saying? Saudi Arabia just has so much oil, so available that it would be a very tough battle. So the opportunists don't really have enough oil that they can marginalize, Saudi Arabia. Saudi Arabia is always going to be the big player. So really the only game is to get along with them as much as possible. Occasionally there's infighting. So OPEC will set something and then there's a member of OPEC will want to violate. But that's usually small scale, things like that, because again, Saudi Arabia just has so much oil available that there's really no competing with them. All right, so any questions about that? Pretty clear? All right, so let's drill down and actually start building some of the models that we can implement so we can actually get these trajectories out. So we'll first look at the kind of the simpler side of it, the independence and the standard microeconomics, free market microeconomics here. And so if we zoom in on the independence, we're gonna start here. This is the basic stock and flow model, and then we're going to zoom in a little bit farther to see the more detailed view here. But we basically have a major stock here, the independence capacity, and the independents themselves have to make a decision of whether they increase their capacity or reduce their capacity. And if we think about their investment decisions, these are the factors that go into them. So there's a tax, there's a development cost, there's an expected future price, there's their optimism, and there's this kind of hurdle rate, which is like a threshold for how well they think they're going to do, in order so that if they think they can do better than the hurdle rate, then that might make them it's worthwhile to invest. Otherwise, maybe they don't invest. And so there were some questions, I think, in the perusal about this optimism variable. And this is an example of one of these kind of intangibles where psychology matters in real world dynamics. So when we talk about bull markets and bear markets, a lot of times it's really, there's no objective reason why, say, real estate prices should rise and rise and rise and rise and rise until they eventually pop. Part of the reason why you have these speculative bubbles is that everyone's optimistic about future increases. So it's just human psychology that's driving some of these things. And that's why we actually need a parameter that sort of gives us a way to bias them that, toward growth or toward conservatism or the other way around. So that's why we have to have this kind of optimism here. And then there are some things that are a little bit more objective. So we have the current market price, and we can have statistical models where we can say, given when the current price is this, a month later, historically speaking, it tends to be this other thing. And so if we're thinking a month later or a year later or whatever, we make our investment decisions based on what we predict the price will be after we do the investment. So this is like a lookup table that we could actually build based on expert opinions or data. Development cost, that's objective. How much does it cost to actually do the development? And then taxes, well, that also comes from government tables and so on. The hurdle rate is something that is not objective necessarily, but it's almost again based on psychology of what they think is good enough for them to reach in order to make these investment decisions. So we know that we need to involve all of these parameters, or at least we think we need to. So how do we do that? We build this, which we've now grown our kind of like back of the envelope model into something that's not that much more complicated. There's the independence capacity. That's the main focal stock here. Notice there's a shadow variable over here, independence capacity. They could have connected a line directly from here to there, but for whatever reasons they decided, their style reasons, they didn't want to have that extra feedback drawn over there. And so they decided to put it over here so that it just kind of cleans up the diagram a little bit. But this independence capacity, the reason you see it twice is that this is effectively a shadow variable. So it's equivalent to a line being drawn directly from here over to here. All right, so if we look at all of what's going on here, we can highlight a couple of things. So here's our optimism slider. So for scenario planning, you can choose a bunch of different optimisms and see how it changes the output. Here's our hurdle rate. Here's our expected future oil price. These are all things which are not really easy for us to figure out without talking to subject matter experts. So we can talk to people and say, what is really how optimistic do we think the market is at this particular time, and so on? What is the hurdle rate that people use? What's their threshold for profitability? How do we predict the future oil price? These are things that you have to go to Google or the subject matter experts to look up. So, and we can do that oftentimes as lookup tables. So the expected future oil price, again, if you know the current oil price, there might not be a formula that tells you how to go from current to expected. It might just be a graph that whenever the current value is on the x-axis, you have a future value on the y-axis, and you just draw that graph. And that's what you would maybe load in to that lookup table. Okay, so I mean, we could go through all of this sort of thing here, but the main thing, all that really they've added as embellishment is just this kind of delay component here. So I know that there was a group that asked me last time, they sort of had an age structured model for their population. It's the same idea here, is that you can view this as when you invest, you have to first put capacity into construction, and then after you've built that up, it will eventually turn into actual capacity later. And so this, they've added another stock here just to sort of depict the time it takes to build up capacity. So that's an embellishment here, just that effectively adds a little bit of a delay. It's like things can't go into the stomach before going into the mouth first. And so that's kind of what they've added there. And we'll talk about this, the stuff that goes on. Oh no, I'm thinking even lower than this. And so, yeah, there's a bunch of other embellishments here that has to do with, costs, development costs, current costs, how much underdeveloped reserves you already have. So again, these are all kind of embellishments here, but ultimately it really goes back to that real simple model of the independence capacity and factors, which we think will grow the independence capacity. So then we want to look down, I think, then at the market, the supply and demand loops here. And so it's a kind of a simple stock model here where I've got demand is a stock and price is a stock. And so you might think it's weird to make price a stock because it's not something you can hold in your hands. Like price isn't like water in a bucket. But remember, stocks are state variables. State variables are anything that changes kind of on its own and then holds its value. So price is something which we know at any instant of time, we can ask what the price is, and then we can ask how is the price changing? Because price kind of holds value and then has pressures that cause it to change up and down, that's why we make it a stock. So it doesn't feel like a stock, but because it's a state variable, it's not a function. Price is not a function of other variables. It is only a function of the previous price and the pressures to change the stock. And that's what makes price a stock. So we make price a stock and we make the current demand a stock. And so the change in demand is going to depend upon the price, the current demand, and these sort of embellishments where you can have this kind of like effective, this allows us to kind of modulate how quickly demand changes based on the current time. So, you know, it might be in the 80s, the global economy is going to cause rapid changes in demand, but maybe in the 90s, it won't be. So this allows us to kind of mute how fast demand changes in different periods by imagine kind of being a slider that's here. But the kind of the basic shape of this is just, you know, not worrying about this. It's just this stock, this flow, this stock, and this flow. And the change in price, we just have total production, and we have the current price, and we have the current demand. And so the demand minus the total production, or total production minus demand, that creates a gap, which drives up the change in price. So this loop here, demand into change in price into change in demand, and then that change in demand back to change in price. If we were to follow that all around, that's exactly this loop right here. So these two stocks implement this loop here, where price here is one stock, and demand is, or effectively this gap is really the other stock here. And these two stocks are kind of chasing each other, and that is what ultimately is going to drive price up and down. So this is just basic microeconomics, just spread out into two stocks. All right, so and then like I said, we can add those additional terms. And so that's the kind of easy side of this, the independence and the price and demand. So that's kind of like, that's the sort of stuff, the independence in this, that applies to almost any market, not oil, just any market where you've got free market dynamics. So any questions about that basic idea? We've just got, we've sort of modeled the psychology of the independence up here and how they choose to put oil onto the market. And then based on how much oil is being put onto the market, the dynamics of the price, where if there's too much oil on the market, price goes down. If there's too little oil on the market, the price goes up. Okay. All right. So now we focus on the really interesting side of it, which is the OPEC side of things. So, so there we can zoom in and look at each one of these sectors. And the kind of the really cool sector here is the swing producer. Now the swing producer can operate in two different ways. It can operate in the sort of price setting mode, the swing mode, or if it detects that one of its opportunists has gone a little too far, it can operate in a punitive mode. And so it's either trying to set the price to the desired price, or it's trying to set the price to a price so low, it's going to hurt the opportunists and get them to stop producing. All right, so if we look, so the swing mode or the punitive mode. All right, so I guess I can go back and maybe we'll look a little longer here. So these look very similar, right? So if I look in the swing mode, I just have, this is the same stock as in both modes, production, and there's a flow here, but what determines the flow changes. So here, we've got the market price and the intended price, and the gap between those, combined with the swing producer's quota, is what causes the swing producer to modulate, to dump oil on or take oil out of the market. So inside here, we've got a formula which is going to say attended price minus the oil price. That gap is going to be proportional to this flow rate, where if the intended price is too high, then they are going to reduce the production. If the intended price is too low, they're going to increase production so that they can regulate intended price to the market price, or the other way around, the market price to the intended price. Now on the punitive side of things, there's going to be a part in the model where they're going to detect whether one of their opportunists has produced too much oil. And so in that case, they've swapped out the intended price and they've now put a punitive price. So they've agreed that if we detect an opportunist has gone astray and has started producing more oil, we're going to lower the price of oil to like $5 a barrel or something like that, like something super low. And they're just going to start dumping and dumping and dumping oil until the market price goes down to the punitive price. And as they do that, then the opportunists are going to feel it and they're going to realize that it's their fault that the swing producer is acting this way. They're going to back off. And in backing off, it will actually buffer the price a little bit the swing producer will tell that the price is not declining as quickly as it was before, and then they'll back off and let the price go back up to the intended price again. And so that's what's being modeled here. All right, so then that's what's happening up in the swing producer. So then we have to then, in the other sector in OPEC is the quota setting sector. This is when all of the OPEC groups come together and they decide on who's gonna make what. And so in the quota setting here, we've got quota as our stock. And so again, anything that changes over time that is not a function of other variables must be a stock. So quota does not feel like a stock. It doesn't feel like a bucket of water. But I don't know what the quota is without knowing what the quota was in the past and knowing how it changes over time. Because I can't use a variable, I can't just make it a function of other things in the system. It has to be its own stock. It has to have memory. So that's why quota here is a stock. And every stock has a flow. And now I just need to have a formula for how to change the stock. In other words, a formula for the flow. And so here there's, let me see if I've got this broken out any at all. Okay, so here, I've got this bias term out here, which is kind of like their version of a optimism. So it's, do they have a bias? How sensitive are they to moving the quota around? And then they've got an estimate on, based on the global oil demand and the independence production, how much do we think the world is going to ask from OPEC? How much of a gap can OPEC fill in there? And then based on that gap, then they can decide on how much quota is going to be filled in by Saudi Arabia versus everybody else. And so this is them kind of deciding how much oil, what's the nominal amount of oil that OPEC's going to produce. And then on the other side of it here, then we've got, how do we split that up between the swing producer and the opportunists? And so from here, we've got the OPEC quota here, which was just from that previous, that's this box here. And it comes in, and then now in this auxiliary variable, there's some process that we have to model, which splits up the quota between the opportunists and the swing producer. And this might be something as simple as 75% of the quota is the swing producer and 25% is the opportunist. And so, or it could be something more complicated where we can say, this is how much the swing producer could produce. This is how much the opportunist could produce. So this is how much the total group could produce. So based on how much the total group could produce and how much the opportunist could produce, then maybe we'll take that fraction. So if the opportunists have 25% of the total oil capacity, then maybe they'll be responsible for 25% of the quota production. So you can come up with some formula based on these things that you can figure out based on historical data. But we know that that formula will be based on these variables, even though if we don't know exactly what that formula will be, but we could figure out a model for that formula. All right, so that's that. And then the last sector that we have to model is the opportunists, the temptation to defect. And so the idea here is that we've got the opportunist capacity and whether they want to change their capacity. So whether they want to increase how much oil they can produce or decrease. So they've got their negotiated quota, and that is going to go into their production here. Now, if they decide to increase their capacity, and that might increase their production, that would end up being kind of a defection there. And so, what we've got here is this surplus utilization that is basically a model for how likely an opportunist is to start deviating. And what this curve requires here is if you look at the price gap from the market price, you've got this surplus utilization here. If the price gap is way less than that, so in other words, if the market price is far too low, then the opportunists are going to do whatever the swing producer wants them to do because they want to raise the price. They have no desire to start producing more oil. But as the price gets closer and closer to the market price, the temptation to defect gets higher. So in other words, as you start bringing the oil price up, then you can start kind of shaving off of that. And you can say, well, I'm going to produce a little bit more than we've agreed to produce. Nobody's going to notice. And I'm not going to make that much of a dent in the price. And so I can now make a little bit extra out of it. Or to put it another way, if you start producing so much, capitalizing so much on the high prices that you actually dent the price, then this is going to say that you'll actually stop producing that surplus because you've dented the price so much. So this little S curve is their way of, of modeling how likely the opportunists are to modify their, to modulate their negotiated quota based on the current price, how close it is to the market price. So, some of the details of exactly how that's implemented in each one of these things are buried within the full model that's in the textbook here, but the basic structure is this kind of cartoony stock and flow here. So it seems like we're finished. And so at the end of Shell's discussions, they said, we got all of OPEC, we got all the independents. But at the end of these discussions, something important happened. The USSR collapsed into Russia. And in the USSR, they had a lot of oil, but it was all inside the Soviet Union. When the Soviet Union collapsed and Russia joined the market, they had a lot of oil that they could sell to the rest of the world. And so that seemed like, before they could say, export, this is the full model, they had to add in Russian oil as a third player. So we had the independents, we had the Russia, and we had OPEC. And this seems really prescient now, right? I mean, everybody refers actually to OPEC plus one. Who's the plus one? It's Russia. So Russia produces enough oil that they are not quite as influential as Saudi Arabia, but they actually are in cahoots a lot of the time. So Saudi Arabia and Russia will say, the OPEC might say, we're not actually planning on increasing oil. And Russia will say, we're not actually planning on increasing our outputs either. So it's not like Russia's a member of OPEC, but they are very aware of each other, and they do have a little bit either of an implicit coordination, if not explicit. So they're just as, and this was the start of that. And so the way Russia got involved here is, remember, there's this stock and the independents, these undeveloped reserves. This is just a stock which is sitting here and currently doesn't have anything connected to it. So this is like extra reserves that the independents have that they're not using. So the way we modeled Russia in there is we said, well, where do those reserves come from? Well, we can actually model them as being gradually over time increased by Russian oil that's now entered the market. Now, initially, no one trusted this Russian oil because they're like, well, what's going to happen to Russia? Do we really count on this oil being available for long periods of time? So they put kind of a delay in here. And they said that we're going to have the risky Russian reserves, the oil we think we can get. And over time, that will be the oil that we think is finally, that we actually believe in. So this is oil that we think we actually can get from Russia. And then finally, we're going to buy that from them, and it's going to take time to agree to rights to that. And then that's going to actually go into our undeveloped reserves. So this allows them to predict in the future that if there's a bunch of reserves that we don't really have trust in Russia, gradually, like a child growing up, and this is like one of those age-structured population things, we have all this oil that a little bit later will become secure and be willing to buy, and then you'll gradually start buying it, and then it'll go into the undeveloped reserves. And that undeveloped reserves, remember, before was just modeled as a stock without any flows. It was just a constant, and that reserves went into this coordinating network, which affected how much, whether they wanted to do more investment. And so now we can plug that in here, and these undeveloped reserves can start growing. As they grow, it'll change how the independents feel about the investment. Now, when they model this, they never imagined at this point collusion between OPEC and Russia. But you can imagine then further developing this model where you actually maybe get dynamics between OPEC and Russia adding to this, even more feedbacks. All right, so that's the basic structure of this model. If we were to draw out the causal loop diagram for the whole thing, this would be the complete picture. We've got the OPEC production, We've got the quota setting over here. There's just a whole bunch of feedback loops. And if I've put on the supplementary documents on Canvas, if you actually want to see the full stock and flow model for this giant model and all of the formulas, if it gives you ideas of things you might do for your own, again, I've linked that from Canvas for easy access. But you know, it's a big model. This is more ambitious than I would expect you to do for your final project. But although not everything might be completely clear, I hope you can sort of see a hint that it's just sort of building on layers of the onion, where each layer isn't that complicated. You're adding on a couple of stocks, a couple of coordinating networks, and gradually over time, you get this mess, which hopefully produces interesting results. And so that's the next step, is to look at these results. All right, so any general questions before we see what this model produces and whether it fits the data or not? Mine, okay. All right, so you put all, yeah.
For the swing producers,
how
much of the market do they have to control? That much influence.
That's a good question. So that would be something that you could actually experiment with this model. So you could adjust the capacity of the swing producers and then see how the price changes. And so when the swing producers are in a mode where they're trying to set the price, you might see a little change in the price behavior over time, but it might not swing that much. And so, it'll end up being kind of determined by everybody else. But then you could scale that initial capacity up. Like imagine it's an initial condition on that stock so that it's gigantic. And then you actually see that the swing producer is pretty much all of the market. So we know that like if 90% of the swing producer, if 90% of the oil in the market is the swing producer, they probably control the price. If 5%, they probably are just may as well be an independent. Exactly how much you need to become a swing producer, I don't know off the top of my head, like if there's a number for that, but that's something that as somebody who's not an expert in oil, I could build this model and go in and I could play with that initial condition and try to answer that question for myself. So it would be an excellent question to investigate with this model. Okay. And that would also, on the other side of it, you can say, how much oil do we need to develop ourselves for us to not have to worry about this swing producer? And that will be something we could experiment too with in this model. All right, so what happens when you hit play on this model? So here's an example coming out of the model where it's simulating from 96 to 2020. And we're plotting the market oil price, that's this thing, relatively stable. It hits a point and then starts oscillating. And then we're also plotting demand minus production. So this is like the supply gap. And so we can see that it's pretty constant here. And then it also starts oscillating as well. And so when we look at this, then we say, well, what happened when this occurred here? Well, if we start plotting more variables from the model, then we'll see that in the model, this is the point where the opportunists started producing, like notice the market oil price is changing here over time. Well, eventually this market oil price is going to get close to the market price desired by the swing producer. As it gets closer here, the opportunists have more temptation to dump oil onto the market to make more profits. And what triggered this was the swing producer noticing this extra oil and then flipping in the model to punitive mode. So these oscillations are the swing producer hammering the market with more oil, causing the price to fall, letting off, causing the price to increase, and keep doing that until the opportunist finally lets off and starts behaving again. So that's an example where we now actually have a dynamical explanation for the spontaneous arrival of these oscillations. It's the swing producer flipping into a different mode. That's the reason why it goes from stable to oscillating. So that's cool. We actually have a hypothesis that makes sense for what's going on there. And so if we look at our historical data here, then this can help explain why we get periods of stability followed by periods of oscillation. This is effectively a stable market, but then suddenly a swing producer kicking in and might be punishing opportunists. So that's kind of the interesting thing here, is that this might actually be a result of internal strife within OPEC that has nothing to do with the global stage. It just has to do with them managing their own members. That could generate oscillations similar to oscillations like these. So that gives us kind of a further insight into this model. So that tells me that this model, at least I could potentially learn something by playing with this model and seeing that if I can generate different spots on this graph to sort of understand what's going on here. And then imagine, what are the possibilities? Like, are there crazy outcomes here that I've never seen before, that because they exist in the simulated model imply that they could happen in the real model? And how do I prepare for those if they did? Okay, so that's kind of the general idea. So are there, there's a lot more that we can say. The chapter 8 goes into a lot of other scenarios. And this isn't a course on the global politics of oil, so I don't want to go into all those details, but I just want to give kind of a tangible example of the things you potentially can do with these models. So any questions about that? Does that basically make sense how this oil model works? Okay. All right, so I purposely made this lecture a little bit shorter so that you have more kind of lab time if you want it. You don't have to stick around for that. Looking forward, we've got lecture F2 that is coming up not Tuesday. Remember, Tuesday is your check-in day. So that next lecture is coming up a week from today. So the next chapter, chapter 9, is due a week from today. Then chapter 10 is due the Tuesday after that. So on Tuesday, again, I already kind of explained this. Over the weekend, we got the muddiest point. Don't forget there's homework E5 that's due. And I think that's pretty much it. So with that, let me end with our second attendance question. And like I said, that's all that I'll have for you today. Happy to help you guys with your final projects, or if you'd like to just get out of here early, that's also fine. So the question I have here is, let me think. So I'll ask, what type of dynamic variable was the oil price in the model in chapter 8? So was it an auxiliary variable? Was it a stock? Was it a flow? So, what type of variable did they choose for price? And that's all I've got for you. All right, so I'm going to go ahead and stop the recording. And for those online, if you have any questions about your final projects or anything like that, just put them in the chat or unmute. Otherwise, that's all I've got for you today, and we'll see you Tuesday for the check-in assignment.